Selecting stocks based on their popularity has tremendous risks. That's the view of contrarian fund manager regarding capital management, who warns that buying these stocks carries the risk of capital loss. Joining us from our Cape Town studio to discuss the dangers of running with the herd is Linda Eads. Hi, Linda. Now, Linda, you're well known at RCM for being a contrarian fund manager, so we would expect nothing other than you warning against going for the popular stocks.
That's right, yes. As value investors, we typically tend to invest in the stocks where there's bad news.
So you're highlighting this as a particular risk that although people are trawling through what the unit trust funds hold and what the big star investors hold in their portfolios. So do you see this as a general practice, seeing what has a high weighting in portfolios?
Well, you know, we've noticed that a lot of investors do look at what the institutional investors are holding and use that as a basis to decide which stocks they should invest in personally. And there are 2 points. First of all, that a lot of the stocks that are held because they're big constituents of the index. So many asset managers will hold them to a greater or a lesser extent throughout the market cycle. And secondly, you know, the stocks that are popular, where the price is already pricing in a very rosy future, often there's a lot of risk involved in buying those stocks when they're at the height of their popularity. We prefer to invest in stocks where the prices are very, very low because there's some short-term bad news in the market. And platinum stocks are an obvious example of this.
Linda, just before we talk about some of the specific stocks that these unpopular stocks that you've been looking at, what you've been talking about here talks a lot to some of the investor psychology issues that people face when they're trying to decide on a particular investment or take on particular risk. Perhaps for the benefit of our viewers, you could just tell us a little bit more about, for instance, the confirmation bias that investors face, as well as this herd mentality and where that comes from.
Well, you know, from an evolutionary perspective, we have been built to believe that there is safety in numbers. And unfortunately, the exact opposite applies when it comes to investing. It's actually when investors are all favoring the same stock and they're all sort of looking at each other and sort of for that affirmation that the stock will continue to carry on with its price momentum, that there's the most risk in a stock. And actually, as human beings, we tend to view those stocks that are unpopular as the risky investments. But you've got to ask yourself the question, is there more risk investing in a stock that is very, very cheap because there's bad news currently, or is there more risk in investing in a stock that is priced well above what it's actually worth because there's momentum taking it even higher? We would obviously argue that the former is a better investment, but unfortunately from an evolutionary perspective, we haven't been programmed that way.
Just in terms of talking about that, we look at companies that you say have lots of bad news around them, but that are fundamentally good. I mean, how do you make that distinction between an issue or an influence that affects the intrinsic value of a company and something that's more superficial and will pass with time?
I think, Warren, it comes back to taking a step back from the current market environment and saying, what is your investment thesis for this particular stock? So for instance, if we look at platinum, you have a simple supply and demand equation when it comes to platinum, as with many other commodities. Platinum prices have been very, very low because of the global cycle. It's mostly an industrial metal used in automotive manufacture. And it's been so low that the cost of actually getting the platinum out of the ground was higher than the platinum price itself. So what's happened is a lot of the smaller platinum miners who came into business at the height of the platinum boom have, quite frankly, gone out of business. So supply is dropping just from the capital cycle perspective. In addition to that, obviously tensions are going to be in the industry when an industry is under pressure. Lots of strikes, etc., and production volumes are falling even for the big three players. Now, the fact of the matter is that those three platinum stocks, the ones that we've invested in, Amplats, Implats, Lonmin, they sit on 90% of the world's platinum reserves. At the end of the day, supply will drop, the demand side will pick up at some point in time in future, and those two dynamics will see the platinum price rising to more sustainable levels.
So Linda, what you're saying, you're not after cheap stocks for its own sake. You really dig into what and trying to find out what the true fair value is for that stock. But now, typically value investors have the luxury of time. They've explained that to the investors that this may not materialize in the next quarter. And I think a lot of the more mainstream investment houses might have that sort of pressure where they need to deliver results. And if you sticking with your convictions, it's painful in the short term.
You're right, Erica. That is a lot of the motivation for staying away from these stocks, that there might be further bad news in the short term, that the prices might fall even further down in the very short term. We're okay with that because it presents opportunities for value investors like ourselves, whose clients and investors accept that a longer time horizon is absolutely essential if you want to take advantage of these. But you've got to come down to what is your definition of risk and what do you want in terms of returns. We would argue that risk is not actually volatility, it's the risk of permanent capital loss. That risk is higher investing in popular stocks than it is investing in very cheap stocks, which may have, short-term negative news but are fundamentally undervalued. And if you think about returns, if you want to generate real returns above inflation, you have to take a long-term view. So fortunately for us, our investors understand that, and those are our objectives: protecting against capital loss, generating real returns.
So this is reiterating really the mantra of value investors, Warren and Linda, that the entry point is what's important. You're not going after some growth story. I'm thinking of retail stocks. That's the obvious example, believing that there's some growth story that will keep lifting that sector. The entry point is what's important.
Absolutely. I think somebody said there was a saying that the risk in an investment is more often in the price you pay than the stock itself, and at ReCM we agree with that.
Linda, just to turn our attention to some of your portfolios that you're running at the moment, and we note with interest with your Global Flexible Fund some of the choices that have come into the top 10 picks there, and perhaps this talks to your thesis again of selecting unpopular stocks. You've got, I believe, the French retailer Carrefour at the top of your holdings at this point. Could you just describe to us what you've seen in companies like that?
Well, Warren, that's a great example of contrasting very expensive local retailers who are trading at ridiculous 3 times their standard deviation above their long-term mean in terms of price to book value ratios, versus a retailer like Carrefour, which is exceptionally cheap right now because of the bad news around the European retail story. Now, Carrefour is the second biggest retailer in the world after Walmart, and yes, they're going through some difficult times given the global economic cycle, and particularly in Europe. But they do have the biggest market share in most of the markets in which they operate, or a significant market share. That's very important for a retailer in terms of economies of scale, bargaining power with suppliers, and sort of long-term viability. Now, Carrefour's share price is so low today that for the price you're paying, you're effectively buying their property book, less their debt, and getting the rest of the business, the ongoing concern, for free. Now, we think that this is a business that will weather the economic cycle, and today's the time to actually be picking up those bargains in the market. High quality businesses trading cheaply because of what we would argue short-term pressures. That's
talking about Europe. On the local scene, we see that for almost 2 years now that Sun International has been one of your top picks. To my knowledge, there hasn't been any negative or bad news about Sun International. Perhaps it's more a cyclical play. Could you explain why you've selected that one and why it continues to be one of your biggest stock picks at this point?
It is indeed, in many respects, a cyclical play. Sun International, the business is, the revenues come more out of the gaming side than the hotel side. But of course, the hotel side, there's obviously a lot of excess capacity which is being worked through the system. Again, very much a normal capital cycle adjustment. There, it's very interesting. If you actually look at Sun International's PE historically, it really does fluctuate with the operating margins of the business. and the margins themselves fluctuate with the economic cycle. What investors tend to do is when a business is at a cyclical low because of where the cycle is at, they tend to extrapolate those earnings figures into the future in perpetuity. Instead of looking through the cycle and saying, right, we're at a cyclical low, what are the more normal sort of margins, revenues that this business can produce over time, and is this presenting an opportunity today? Sun International, you mentioned 2 years. For us, 2 years is not a full time horizon. You're looking at full market cycles, sometimes 5 years, sometimes even longer. But Sun International, cyclical pay at a low cycle point at the moment, and the market is undervaluing it as a result.
Belinda, you've made it clear you look for those stocks that the market has shunned. Now, what about a stock such as Telkom? I think it's a stock that everyone seems to love to hate. Are you seeing some glittering opportunities there?
You know, Telkom is one of those where, you know, from the word go, we differentiate between a high quality business and a low quality business. And we will never take the same size position in a low quality business as a high quality business, but sometimes low quality businesses are priced so cheaply that there's an opportunity there. Unfortunately, Telkom does fall in the category of low quality businesses. We have actually had to adjust our fair value downwards as the negative news has been worse than what we expected. Even though we put in some sort of deteriorating assumptions there. But yes, we feel that although there has been negative news, we've revised our fair value downwards. The prices obviously also moved downwards. There is still some value there. We're still prepared to hold a position in Telkom today. But very different business. Carrefour, Amplats, all of these are what we would consider high quality businesses.
Linda, I'm a little bit surprised to see Berkshire Hathaway make their way into the top 10 holdings, because obviously the reputation of the man running that business is unparalleled. And Charlie Munger and Warren Buffett spend a lot of time talking about what they think is the intrinsic value of the business, which makes it difficult to find it mispriced, in my opinion. I just wanted to ask you what you saw there in particular in that conglomerate.
Well, yes, I mean, there are value investors with exactly the same sort of philosophy, if you like, about allocating capital to investments. We simply watch that share price quite carefully, and we increase the position when there's an opportunity. We still feel relative to the underlying assets that there's an opportunity there, and it really just comes down to a simple price to fair value opportunity with Berkshire Hathaway.
I'd have to make, just on that, I'd have to make a strong case that the intrinsic value of that business has grown in line with two individuals there in particular, both of which are fairly old. How does that succession planning fit into your thinking around Berkshire Hathaway and other companies where you have this very dynamic founder that has built a company up?
Well, yes, in terms of capital allocation decisions in the future, obviously the succession planning is an issue. But the way that we look at the business today, the assets that they've got in the business are of quality. We believe that there's an opportunity there. If something had to happen to those two gentlemen, they are getting a bit long in the tooth, of course. We feel you're getting sort of a free option, if you like, on the capital allocation decisions of the future management team. We're not pricing that, put it this way, we're not pricing that into our fair value today. We feel you're getting that for free. We're not pricing an upside based on what they're going to do in future. We're looking at the assets today and making a decision on that.
Linda, thank you. I think plenty more questions. In fact, I'd like to, let me ask you very quickly and briefly, the fair value, and I know that's really the nub of it. That's what you and your guys spend your days doing, working out what the fair value is on a business. Just briefly, what does it entail?
It's really simply the future cash flows of the business from the future discounted to today's present value. That's what it comes down to. Whether those are in terms of the revenue numbers or even the dividends, it comes down to what is this business worth today given its future cash flows. And there are various ways that you can do that calculation, but that's ultimately what you're trying to assess.